From Impact Alpha, it's This Week in Impact, where we bring you some of the most interesting impact investing stories of the week. It's Friday, May 23rd. I'm Brian Walsh, and I'm joined this week by Impact Alpha editor David Bank. We'll discuss Don't Call It a Spend Down, unsolicited ideas for sunsetting the Gates Foundation. Plus, returns on inclusion, how California's massive public pension funds find alpha in emerging fund managers. And finally, we'll check in on the state of blended finance. Is it on the precipice? That's all coming up on This Week in Impact. Hi, David. How are you doing this week?
I'm doing very well, Brian. I'm looking forward to the long weekend.
Indeed, it's Memorial Day here in the U.S. All right, well, for our first story, impermanence is the future. The Gates Foundation, the world's largest philanthropy, made headlines this month with the announcement that it would double its annual giving, distribute around $200 billion, and sunset the organization by 2045, decades ahead of schedule. Santosh Ramdas of Gary Community Ventures had a guest post for us this week offering 4 unsolicited ideas for how the Gates Foundation might think about going out with the biggest bang for its billions of bucks possible. David, you've covered the Gates Foundation, along with Microsoft, the source of its wealth, for decades now. So I know you have a lot of thoughts on this. How have you been thinking about this news?
Well, it's interesting it got so much attention. I mean, I think what it really signaled was Bill Gates kind of stepping up at a moment when there is, shall we just say, a need for both his billions, but also his leadership on things like global health. And the Gates Foundation, has been a major funder, along with institutions like USAID of, bringing, medical treatments to countries, low-income countries and people who can't afford them, and vaccination programs for children's health and that sort of thing for many decades. And as the USAID in particular, $40 billion budget has kind of been vaporized, but other countries as well have cut back on that kind of, direct kind of overseas development assistance, what people think of as foreign aid. How can Gates Foundation step up? And if they're going to step up and increase their spending, then the endowment growth may not keep up with that. And so by definition, they're spending down. So why not make a virtue of necessity and say we're spending down, which is what Gates and the foundation said the other day. And that just allows them to raise their giving at a time when it's most needed.
All right, well, let's start with Santosh's first of 4 recommendations. He said, don't call it a spend down. Why that framing? Because I know a lot of kind of media coverage of this is saying that the foundation is going to be spending down its endowment, but why not call it that spend down?
I think it's just framing. It sounds like riding off into the sunset, which is the other word that people use. Which has all kinds of resonance for folks. So I think it's more like actually the urgency of it. It's like you're spending it now because the problems are so urgent that why would you just hold it in an endowment? Especially a non-aligned. Impact investor types would understand. If you have all that money sitting in the stock market, say, or in other kinds of investments, some of which may be doing actual harm, and you're trickling out a very small amount of it, each year as, programs that are supposed to redress that harm, you may not even be getting ahead of the game, and, most likely you're not. And so it's not really spend down. It's actually, do it, just do it is really the better way to say it. And even so, it's only a growth of, maybe 6 billion only is relative in this case, is because Gates Foundation is one of the biggest, distributors of cash, but it does raise it from about 6 billion a year to 9 billion, as I understand, and maybe more as it goes forward. And that's a lot of money, but it's not nearly enough to kind of change the game on sort of the overall needs, as we've said. So I think what's maybe more interesting is, the leadership and whether other foundations will follow suit. This has been something people have talked about for many, many years. I wrote a front page story in the Wall Street Journal in 2002, essentially making this point about the time value of money. And it's something like, reduced by half if you just let it sit in the endowment and dole it out at 5% a year. You're essentially, reducing the impact value of that money as opposed to the time value of the money by half. So, there will be rich people in the future. They'll have philanthropies, and the value that you get out of having those interventions now is can be extreme, especially in things like disease prevention and that sort of thing, where you're preventing a pandemic in the best case.
Right, and that gets to the point that Santos makes as well, that quote, with perpetuity no longer the driving force, as so many foundations do have perpetuity for their foundations. He writes, the Gates Foundation can now deploy its investment capital with unprecedented creativity and impact. So talk to us about that kind of impact and how they might be able to, since their investment managers don't have to manage for perpetuity, they can then get really creative about shaping markets in kind of unique ways.
Yeah, and I'm not sure. I think Santos may be slightly projecting onto that because I'm not sure I heard that exactly of what the alignment of the endowment in the midterm or long term is going to be in terms of producing those returns. So just because you're spending down, that's really on the spending side. And I'm not sure that what Gates has actually announced in terms of the investment side. But what might be an interesting corollary to this, as you say, if the goal is not to preserve the endowment forever and thus to need to beat your expenses each year by the returns, then you may be willing to put in things that are somewhere above a grant, which is by definition sort of is a 100% loss on that investment. Obviously there's benefits from the grant, but you're not getting the money back, or so-called market rate, where you're trying to compete with all kinds of other benchmarks around private equity and public equities and things. But you're instead aiming for a kind of mid zone where you have lots of impact and you get some returns, and that actually advances the mission with your whole endowment. And that would be a true pioneering and innovation in philanthropy if the Gates Foundation actually goes further in that direction. So I think that's something really to watch.
So with not just their capital, but with their clout, they could have a huge impact if they wanted to deploy their hundreds of billions of dollars of assets under management in a more systemic way.
Yeah, and Santos, is again, and just to be clear, he is the head of a foundation in Denver called the Gary Community Ventures that is itself a spend down, or he wouldn't call it a spend down foundation because he doesn't like that word, but is transferring all of the assets on its balance sheets to the community's balance sheet as the way they think about it by 2035, a decade ahead of where Gates has targeted. And the notion there is not that the money is like out the door, gone, vaporized. No, the money has now been moved from, sort of a private person's assets into a foundation assets. The foundation helps then transfer that to a set of community institutions who then themselves have resources to go forward and flexibility, and are maybe themselves not subject to the same kinds of budget cuts that we're seeing from USAID and also on all kinds of local things. And so you start to stand up these local organizations that actually have their own balance sheets and their own financial health and their own ability to leverage and be creative and expand their services.
And Santos' final point was about turning the giving pledge into an impermanence pledge. Bill Gates, obviously famous for popularizing this idea of encouraging very wealthy people to pledge publicly to give away at least half of their wealth. So what would it mean to turn the giving pledge into an impermanence pledge?
Well, first of all, I love impermanence. I mean, people have talked about, non-perpetuity, but I think impermanence kind of gives it a kind of almost Buddhist feeling of like nothing is forever. And I think that's kind of the goal of this, last suggestion, which is, put some urgency into it. So the Giving Pledge has been tremendous in kind of having folks kind of step up and make a proclamation, but hasn't been so good at actually moving capital, because most of that is going to be done, after folks die or what have you. And so this notion of impermanence and kind of spend down, sunsetting, do it now, just do it, is to put some kind of teeth into that and get the money flowing sooner.
Yeah, I do love the idea, as Santos puts it, it's isn't about diminishment, it's about amplification. And so I think that's a good way to think about this, these recommendations and this, bold new direction that the Gates Foundation is going in.
There you go.
All right, you can read Santos Ramdas of Gary Community Ventures' full guest post about the Gates Foundation on ImpactAlpha.com. There's also a link in our show notes. You can also weigh in on the conversation on our Slack channel. That's exclusive for Impact Alpha subscribers. For now, let's take a quick break. When we come back, how California's massive public pension funds are finding alpha by investing in emerging fund managers. The largest pension funds in the country are the two managing retirement savings for California's public sector employees. CalPERS and CalSTRS have a combined something like $850 billion in assets under management, which sets them apart from their peer asset allocators. And they're also bucking the recent trend of institutional investors going quiet on their diversity, equity, and inclusion, or DEI, efforts in the face of heightened scrutiny and strong armed pressure tactics from the Trump administration. David, you and Rudy Sonatas wrote this week about the issue. What are you finding about the approach from CalPERS and CalSTRS?
Yeah, I went up to Sacramento for the annual Catalyst convening put on by CalPERS and CalSTRS, which are kind of sister organizations, although completely separate, and around specifically emerging and diverse asset managers. And I wrote that it was something of a time capsule from a sort of another era, because the talk from the leadership of those big pension funds was full steam ahead on finding alpha, as it were, in new managers, in diverse managers, in smaller funds, in innovative theses. They've built a kind of business case and a business structure around those kind of investments in a way, and haven't pulled back in the face of the sort of changing politics, which have caused a lot of folks to retrench and certainly change their language. So you actually heard the words diversity, equity, and inclusion from the stage, from the leadership of the two largest pension funds in the country.
And what kind of pushback might they expect from this? I mean, could the Trump administration come after them in some way?
Well, there's always that, and there's certainly, examples, as everybody knows, from the universities, the law firms, and everything else. And what was remarkable was that not just the top leadership, but also the heads of all the different divisions, real estate and infrastructure and private equity, were making essentially the business case that maybe the Trump folks would understand, which is this is where the returns are, this is where the advantages are, this is where the new pockets of untapped alpha reside. And so to not look for asset managers, fund managers with sort of compelling theses around the new diversity in the population. I mean, California is kind of a leader in becoming a majority minority state, and the whole country is going to be soon following California's model. And so it's not just sort of a blast from the past, it was really sort of almost a sort of signal from the future, that California's figured out a way to do kind of what finance starts to need to do in a changing world, and the rest of the world and pension funds from other places may learn something. I did one thing that was interesting is they made the point that California's operated under Prop 209, which voters out here passed in 1996, which essentially barred any kind of racial or quotas and that sort of thing in public decision making. And so everybody has had to adapt to that, and in fact follow, as I say, the returns. And it's the returns that take them to diverse and emerging managers, not any mandate to for some kind of wokeness or anything.
Now, also at this Catalyst event in Sacramento, you reported on the CalPERS change to their co-investment strategy. Tell us about that.
Yeah, well, this is kind of something wonky part of the private equity world that we've been following, which is the power dynamics between LPs, like the big pension funds that have the money, and then the GPs, or general partners of the funds, that are trying to raise it. And one of the things that had happened over the last few years is that the LPs, trying to minimize their own fees that they have to pay, had insisted on not only being part of the fund, but also having access to the deal flow of those GPs and getting in on those deals for no extra fees. And then if you think about it, that if you average that over the whole allocation, then their fees are lower for the whole thing. And so this had become quite a point of negotiation, and folks were saying, this is great. Now we have these managers working their ass off to find us deals, and then we come in and swoop in and they've done our homework for us. And that went on for quite a while, and that was part of the way the industry was working. And what came out at this on this panel was that hey, if your managers are not finding good deals, then getting in on them for low fees is not really going to boost your performance. So what you really need to do is just focus on the managers who are going to be putting together compelling propositions and compelling deals. And so really go back to basics and focus on manager selection. And that was really the takeaway from the whole couple of days there was, that it's a pretty narrow funnel for managers to get through. It's like, a couple or three or four are going to get through every day from the hundreds that are seeking capital. And so you better have something to offer these big pension funds when you come asking and for them to put their money with you.
All right. Well, you can read David and Rudy's full story on the California retirement funds on impactalpha.com. There's also a link in our show notes. For now, let's take one more quick break. When we come back, we'll discuss the precarious state of blended finance during a time of pullback in foreign aid. Blended finance is an approach that uses philanthropic, catalytic, or concessional capital to attract larger amounts of commercial investment into emerging markets, particularly for opportunities that might otherwise be considered too risky. The Canadian-based Convergence organization has been supporting and tracking the market for blended finance for years, and our Jessica Pothering recently covered their annual report, The State of Blended Finance 2025, which was published this week. The news is not good for proponents of this approach to global development, nor the billions of people in emerging markets who might benefit from these types of deals. David, what are we learning about the precarious state of blended finance?
Well, as you say, the report was called The State of Blended Finance. It's really kind of the state of the world, and certainly the state of emerging markets investing, which, is always kind of the first to take a hit when things get, more volatile or risky. And so I don't think, on my read of this, that this is really an indictment that blended finance doesn't work. It may be, an acknowledgement that blended finance, putting incentives and risk mitigation, tranches into these big deals, is not enough to overcome the headwinds of folks just retreating from emerging market investing, more broadly. And so, it's one of these things where, blended finance has always been kind of ever on the verge of arriving, and a couple of years ago it really was arriving, and there was a whole number of billion-dollar deals, and we covered them in quite some depth in Impact Alpha, where a small tranche of a risk mitigation, a $25 million guarantee from the MacArthur Foundation could unlock $100 million from the Dutch development finance institution FMO, and that unlocked $1 billion from the German insurance company Allianz. And that just seemed like a formula you could, rinse and repeat and really bring some real capital to bear on, say, the Sustainable Development Goals. Then 2024, slow down, pull back, and now 2025, USAID, a major investor in a lot of these kind of deals, and certainly a proponent of this kind of leverage to bring private capital, to bear on traditional kind of foreign aid, responsibilities, out of the game essentially. And everybody's like, oh no, we're back to square one. And Joan Laria had this, chilling quote, where there's no question that we're standing on the precipice. The only question is sort of how far we fall and what we do about it. And so I do think, that it'll come back as people, realize that there are opportunities and that there are these mechanisms that can assuage their concerns about risk.
So the main takeaways here seem to be that the decline is due to the cut in aid budgets, but it's also this high perceived risk in emerging markets from commercial investors in general. And then I think you hit at this a little bit too, the idea that these deals could be replicated and scaled is also a perennial challenge in the blended finance space, that people find that the deals are time consuming, complex, and costly to structure. So where are we on the standardization of these blended finance deals and, the kind of rinse and lather repeat of these transactions?
Yeah, I mean that's where where we were almost there, and now taking a step back. But there is some bright spots, and even the report calls it out that the multilateral funds, like the Green Climate Fund and the Green Guarantee Company, are more in that mode, as you say, because they are taking in capital from multiple sources. They're putting it out in across deals, but in kind of a replicable way, and so they're less one-off and they're more kind of repeatable. And the Green Climate Fund, after a sort of rocky start, has really, turned out to be a sort of key layer in a lot of funds and attracting, private capital, on top of that. So just this week, something called the Private Infrastructure Development Group which has an emerging Asia and Africa infrastructure fund, got a $325 million debt facility from Allianz again, Sumitomo, Mitsui Banking Corp, Swede Fund, ABSA Fund. Some of these are kind of usual suspects in blended finance deals to invest in infrastructure projects in Africa and Asia. So deals are getting done. People know how to do them. They're becoming part of the kind of toolkit in finance, and I think when the world right sizes up again, and folks see that there are opportunities in these growth markets, blended finance will certainly be in the toolkit. So the question is, how fast and how much, and whether that will be enough to take advantage of the opportunities.
All right. Well, you can read Jessica Pothering's full piece on Convergence's State of Blended Finance 2025 report on ImpactAlpha.com. We'll also have a link in our show notes. But for now, David, that's going to do it for this episode of This Week in Impact. Thank you so much, David.
Well, thank you, Brian, and thank you for letting me rant on.
All right. Well, it's always a pleasure. Always good insights here. Thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks as always to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh, Managing Director of the strategic advisory firm Human Nature. We'll see you next week for more Impact.